Hello, everyone, and welcome to one of our favourite episodes. And it's great because it happens once a month. It's Market Update. We're looking at the month that was January 2026, the first one of the calendar year, and quite a few takeaways. So thankfully, I've got some industry heavyweights with me, metaphorically rather than physically. Dave Johnston and Cate Bakos.
Good on you, Mike.
Before we get into today's episode, we should just remind our listeners we've got the live podcast recording coming up in just a few short weeks at Latrobe Golf Club. So that is on, someone remind me, is it Thursday, February the 8th?
The 5th.
The 5th? Close.
March, because February's we're already
that's
past
right.
then.
Yeah. So nailed that. Only just thought that we should mention it in our intro
and
while you were talking.
If you love our incompetence in recording, you'll love it live.
Exactly. Come and listen to us stuff up live.
I'm only picking on you, Dave, because I think the last time I did it was exactly the same. But
right.
So
come and get some free books, have free drinks, free food.
See Pete.
See Peter, the property professor Kalizos, who'll be joining us as MC on the night. Ask any question you like in person. It should be a fun night.
And if you're a million miles from Melbourne, you'll be embarrassed to know that there's people flying in from other cities. But if you can't make it, and of course are in a different city, the intention is to record a completely live podcast that will actually go to air on our channel, unless the gods of audio-visual smite us on the night. So you'll be able to be a part of it, but you won't get the atmosphere, you won't get the drinks and the nibbles. So we'd love you to get along, and the link to get the tickets will be in the show notes.
How's
that?
Notes.
Sounds
good. Pretty good.
We'll get into the market update.
Let's get into the data. So the month of January, we saw a 0.8% increase, and really increases across the board. Every capital city, the combined capitals, the combined regionals, we saw some growth. And it is, I feel like it's a bit of a Groundhog Day, like Brisbane, Adelaide and Perth. They've been doing their thing since 2023. But we've also got Darwin, that was the top performer for the calendar year 2025. It's actually in second place for the month. Starting with you, Cate, what are the takeaways for you in those core logic numbers?
Yeah, a bit of strength with Perth. I mean, 2% off a median value of almost $1 million. That means if you're shopping in Perth and looking at median price stock, it's moving 20 grand a month. Now, that's really tough. I also note that the combined regions outperformed the combined capitals again. And January's a funny month. We have to think about listing and sales activity in January. You do tend to find that your capital cities should be dormant, because that's the agent's opportunity to take a break. They all go away. But if you've grown up on the coast, or you've grown up outside of the metro cities, you'll know that it can often be a really busy time, whether it's a university town with a bit of turnover happening around that time of year, or whether it's coastal and people are getting excited about purchasing when the weather is fantastic. Not every single city shuts down for the January market, but for those that do, I always think January is a little bit of not a non-event month, but a really hard one to take the temperature with, because it's different.
Yeah.
And Dave, I was going to ask you, obviously the elephant in the room is the RBA announcement, and the combined regionals doing better than the capitals. It makes me kind of think about affordability, especially given there's no indication that this is the end of rate cuts for 2026. What was your read on that?
Well, look, there were a few potential headlines to note to our listeners. They may have made the news somewhere already, but the combined capitals, so the combined capital cities, all dwellings median value cracked $1 million for the first time ever. So that is just ticked over $1 million, $1,200,520 to be exact. Another city that moved up a rung in the rankings was Adelaide's all dwellings median, overtook Canberra's. So it's now in fourth spot at 914,000 behind Sydney, Brisbane, Perth. So, yeah, Adelaide's up in fourth. And that's that continued story of Brisbane, Perth and Adelaide that we've spoken about and obviously been happening for some time. So Canberra fifth, Melbourne sixth. And then to the point you just made about Perth, Cate, well, their houses, the median value for a house in Perth has now cracked $1 million. So it's in fourth place behind Sydney, Brisbane, Canberra. So we just, we're seeing this $1 million price bracket becoming the norm across more and more capital cities. So that was one takeout or noteworthy story of some of the changes in January.
It's been really jumbled up, that leaderboard, hasn't it? Because before the pandemic, it was always really Sydney, Canberra for weird reasons, then Melbourne, and then you'd have the rest, and it went all the way down to sort of, Darwin and Hobart. But there's been a real reshuffling of the deck, and it's been a really wild thing to observe. And I suppose the RBA coming in and giving us that 25% basis point whack was a unanimous decision. And I watched an interview with an ex-RBA board member, which is, I think, a really interesting thing to observe, because you never hear current board members speak. They're hidden in the shadows. They obviously can't sort of go off script, and really Governor Bullock is the only one that's got the either the ability to do it or the media training to not get themselves in trouble. But they were just talking about an overspending government, expanding public service, and aggregate demand outstripping supply, and they really kind of feel like this is a fiscal problem rather than the RBA's problem. And of course, we need to look at those two things in concert. What do you guys think? Is the government overspending, and that's why we're in the situation that we're in?
I think that's certainly part of the issue. Absolutely. I think we overspent through COVID and didn't have some mechanisms in place, like, for example, New Zealand did, which meant we overpaid too many businesses that didn't actually need that level of support after the initial period. We had no clawback on some of the overpayments that occurred. And I just think we went too far into debt, and now we've gotten used to it. Australian society have gotten used to government spending to solve problems, and we've almost become blinded to government debt. And I think historically, Australians would go, oh, we've got too much debt. We don't, we shouldn't have this level of debt. That's going to cause issues. And now it's almost not even considered, I think, by a lot of the electorate. So I think that's a serious problem. I think politicians or political parties should start talking about numbers and just repeating it, that cut through. So like we are paying this much interest per month or per week, or those types of things that people can sort of relate to.
But
Otherwise,
do you think people generally care, Dave? I mean, we're pretty selfish, and I think if you polled the average Aussie and said, "Here's our debt level," will that influence you at the domestic level? They'd say no.
I think, but I think it's that old story. The politicians need to learn to sell a message, and they don't do that like they used to. I think you've got to relate it and go, okay, we are spending, let's say, pluck a number, $100 million on interest per month. That would pay for a new hospital, or that type of thing. Relate it to an outcome. Relate it to like the percentage of our taxes that is going towards government funding is I think just about the highest level of it it's ever been. We've got to talk about these things and keep them simple and actually be boring and repeat until you get cut through. It's like coaching kids in junior sport, or you've got to repeat the same messages over and over, but they've got to be messages that people can relate to, not highfalutin, self-interested speak that a lot of the politicians. That's what I think anyway.
Yeah. So is your point that we're explaining to Australians why we need to be taxed higher, or are we trying to influence personal decision making around finances?
Well, neither of those 2 points really. I think we're trying to put pressure on. Well, if you're in opposition, you're trying to put pressure on whoever are the state or federal governments to not rack up so much debt and to spend more within its means. So number one. And number two, I think we pay too much tax as a society relative to the percentage of tax, personal tax that goes towards the government coffers is too high. It's as high as it's ever been historically. I feel like the number might be like 28% of all government revenue or something. So, yeah.
That would suggest that we need to cut some of our services and some of our benefits. And the hard question is, what stuff do we cut?
It is, but you've got to come up. We've got to make decisions. You've got to pare some things back. You've got to be smart. It's the same as running a business. It's the same as running your personal finances. So, otherwise we'll just continue to bleed and become a nation that more and more requires on government. And when government overspend, it cuts out private businesses and private investment. And ultimately that's what grows the pie. That's what creates...
Dave Johnston.
Yeah. Well, I mean, there's a fairly strong argument to say that the coalition haven't been really doing a good job at holding the government to account on spending. This is a perfect opportunity because interest rates have gone up. That's unpopular with basically everyone that isn't 80 with a term deposit and no investments. So
I reckon the coalition have had a bit of other stuff on their plate, Mike.
Yeah, true. That's true. But, I mean, we've seen a huge rise in popularity for One Nation. And say what you like about Pauline Hanson, she is good at sticking to a message, right? A very, very simple message for the electorate to understand. That's obviously resonated to the point where now she's out polling the coalition for, I think, the first time in history. And there's a lot of people talking about her eyes on the top job. I don't think has a hope in hell, really, because she's got to get a lot of seats for that to happen, and I don't think they have enough members at the moment, but could really be sort of a bit like the Democrats back in the day, where they did have a legitimate sort of like hold on that balance of power. So that'll be an interesting one to watch.
Yeah, it will be.
I did see a chart that talked about like private demand was the big driver of inflation rather than government expenditure, despite the fact that we've been talking about government overspending, which I still think is true. But 80% of that private demand is coming from the increased population, which is an immigration story as well, apparently. And immigration is obviously an area that One Nation have been on since day dot. So it'll be interesting to see how that all plays out. But we are just observers and commentators, I guess. Let's get...
I've got one little thing to add. Like, we've chatted briefly about the interest rate increase, and here's a bit of an insight into the Cate Bakos Sunday afternoon ritual. I read through the questions that the journalists asked Governor Bullock, because there's a lot of gold in that, especially with her answers. And, she's speaking off the cuff, which I always admire when someone's got to answer lots of tough questions. And one of the questions was asked, obviously, with a negative slant about the rate increase. And she said, quote, "This interest rate rise sort of comes across quite negatively. We're actually in a good position. The labour market is really strong. Domestic demand is recovering. These are good things, but it's just that we're supply constrained, and we think we're even a little more constrained than we thought back a little while ago. So yes, the strategy is still trying to bring the economy back into balance and the labour market back into balance without overshooting, and some other countries have done that." I thought that was interesting, particularly her saying we're actually in a good position, because we've got a governor who doesn't puff things up and doesn't like to comment on the future. She's very clear about that with every second answer she delivers. but to state that we're actually in a good position, is that a bit of a hint that they really are taking a firm grip on this and they're confident that this has done the trick? I don't know. You can read into it, but I thought that was an interesting para.
Yeah. Yeah, it'll be interesting to see how this kind of washes through. There's a lot of comments around it taking sometimes 18 months for an interest rate change to wash through the economy. But, we've seen the impacts of some of the cuts come through. But, yeah, we've just got to watch that data. Labour market is an interesting one. I think unemployment is still a bit lower than what they'd expected, and that sort of speaks to the supply constraints.
See, it's not really what you want to hear, is it?
No.
Unemployment's a bit lower.
Are saying we didn't raise rates high enough. And so now we are the first nation, I think maybe the first OECD nation to raise rates in this cycle. So, potentially we didn't do something right. We went too high. We didn't go high enough at 4.35. And then people are arguing we brought rates down too soon last year. So a lot of the other OECD nations, Reserve or Federal Reserve, went above 5%. And we were very focused on keeping unemployment low, which we've done. But now we've had to start raising rates before anyone else, essentially, in the world. So I've read that initially Michelle Bullock said that she wouldn't bring rates down until she had 2 quarters of data to make that decision. And then she brought the first rate reduction last year in February after only 1 quarter of information or of data. So, there are certainly, and I'm not sure of that opinion from the ex-RBA board member who you were listening to, Mike, but, there's certainly some economists, some ex-RBA board members who you see talking along these lines that we didn't raise rates high enough to begin with, up where most of the other, Western nations got them up around 5%. We capped at 4.35 and then we started reducing them too soon. And that's why we are now the first, I think the first OECD nation to start a rate hike cycle in the world. Yeah.
Interesting. If we cast our mind back to when we were just screaming at them to drop rates, and I know that you can't ask someone who's meant to be, independent to just reduce rates because we're hurting and we want them to reduce, but every news story was about the cost of living and rents had gone through the roof. It was a really difficult time. And in tandem with that, we had a lot of property markets that were flying even in the face of higher interest rates. If we look at the top 3, they've been humming since COVID. So there were a lot of Aussies feeling the pain out there. And had we held rates or even increased them closer to a cash rate of 5%, it could have been a colossal mess for us.
Well, I guess you could say that, but their point is we didn't actually get inflation under control, so the mess is still going on, and now we don't know how much longer the mess is going on. So the argument is that if rates went higher, we wouldn't still have this mess now of high inflation.
But we were pretty nervous about tipping ourselves into, a recession if we went too hard.
Yeah. Well,
it's such a hard balance, isn't it?
Yeah. Look, I think the thing with where rate settings is, everyone can have a different perspective, and you're never actually going to know which perspective was definitely right, I don't think, unless things go really awry. But certainly inflation being a problem again suggests poor decision-making by the Reserve Bank. But let's see if they can get it under control in a short period of time or not.
Yeah.
Yeah. Do you remember Glenn Stevens' term as RBA governor? I don't think he changed rates for like an 18-month period. It just kind of made me think, like, sometimes it's easy to be an RBA governor. Sometimes there's a lot going on. Yes. The last 2 have had it a bit harder.
Absolutely.
Yeah, but look again, I mean, like Britain, Canada, New Zealand, the United States, they all went up to between 5 and 6%. This board decided to stay at 4.35%, and potentially they're now reaping what they sow. But let's see. Hopefully there's not too many more rate rises, because the worst thing you can do to a nation, and certainly the poorer people in the nation, is have high inflation, and that's what we're giving to them.
Yeah, and she certainly zeroed in on that disproportionately affecting the lower income side of society. Yeah. And you make a really good point about the markets as well. I mean, combined capitals, combined regionals, and adding them both together, we're at the peak. The property market's been humming along. So an interest rate rise could potentially take some steam out of it. But I think it's also the announcement effect that it might not be the last one. So it'll be interesting to see how that washes through, especially with our 2026 predictions. With rents, I mean, rents are a bit of an interesting one. I guess we're past the rapid speed that we saw in 23, 24, but they're still rising at a rate that is unusual. I mean, pre-pandemic, we're talking about 1.5% annualized rental growth, which everyone that's renting right now would love to go back to those halcyon days.
Yeah, I'm looking at this chart, and I'll pop this in the show notes. Our two biggest capitals have shown a bit of a switch, and Melbourne is, for both units and houses, it's pointing to the sky, even though it's in the lower segment. It's definitely done a bit of a pivot. And Darwin and Hobart, they've switched. They've been peaky, and they're returning back to the rest of the pack. So it would be interesting to see what that means for Melbourne and Sydney in particular. I wonder what's going on with Melbourne, because that's a very sharp switch. And we've seen 3 months in a row now of Melbourne delivering positive change. But, this isn't the graph that you want to see it on, really.
Yeah, and we're getting to that point where there's some meaningful discussions about whether it's best to rent or buy. Media loves those articles, like the 100 suburbs where it's cheaper to buy than rent and that sort of thing. But like capital growth and rents have been humming along, but it's a different story between the cities. And it, of course, impacts the yield, and that impacts investor behaviour. We sort of called the bottom of Hobart, I think, a couple of months ago. I think we've done a pretty good job there, but rents are humming along as well, and yields are often a precursor for capital growth. Is there anything that stands out to either of you in the yields across the cities that maybe speaks to the future of price growth in some of those capitals?
Well, look, the yields have certainly been impacted. And one thing I certainly noticed looking at the yields is the story of regions, the regional story. Historically, you could bank on average 5% yields with regional properties. And if we look back to sort of 2016, it's up around 5%. Whereas capital cities, combined capitals was, say, 3.6, 3.7. Big gap, but regionals just keep coming down. They're right down to 4.2%, and combined capitals is 3.4%. So it's stayed more steady over that last sort of 10-year period. So that squeeze says it's getting less and less affordable to live in, definitely, I'm no doubt, major regional centres or, really strong lifestyle focused regionals, which I think something's going to have to give at some point in time, you would suspect. That's certainly something I noticed, that 10-year yield compression for regional rents.
And, I mean, some of the cities like Hobart, 10% growth year on year, Brisbane 7.1. There's acute pressure there, whereas places like Canberra and Melbourne, there is a little bit more relief. But, house rents nationally up 3.4% in just one month. I mean, that's sort of scary numbers.
Yeah, I mean, and this is part of the inflation story, isn't it? Rent plays a big part in inflation. So in the past 5 years, rents have grown nationally about 42.4%. And in the 5 years prior to that, it was only 8.2%. So that's what renters have had to go through over the last 5 years. And that's actually added about $204 per week to the median rent, which is a significant jump for people. Now, obviously, wages keep growing over that period of time, but they certainly haven't grown at the speed of rents, which, that 42% number.
Well, look at combined regions. I think that for a 5-year growth is awful, 57.4. You're talking generally about lower incomes in the regions too. Every bit hurts, and it's colossal growth. And I would love to do a deep dive and see specifically which regions have led the chase there, because we can be certain that there are some that have doubled, and that would be really frightening.
What is a little bit frightening to me from a renter's perspective is the policy around tinkering to capital gains tax. It's interesting to hear some of the politicians talk about the discount costing us. I don't really see it that way. I think that's actually the gains are taxed, so that's a revenue thing. Talking about costing us, $20-30 billion a year, whatever it is, but the cost to actually house the people that want homes, we've talked about it in the past, and I worked it out to be about $2.4 trillion worth of residential assets that somebody has to own. We know from Cate, our work on the PIPA board, that there's a third of people are saying that they'll exit the market if there's changes to capital gains tax. And whether you're pro or against, I can't help but think if there are any changes, we're going to see rents rise at a rapid pace. What do you think?
Oh, 1,000%. We've got to think about what happens when an investor is disincentivised. And we've got some really good case studies, recent ones to point to. All we need to do is have a look at what happened in Queensland when they tried to introduce tax reform around land tax, and that created an exodus. And then, what we've been through in Victoria. We've got some great case studies to point to. And I know that CGT has been, on the agenda for many years, and it comes on and then it goes off, and we could chat to Bill Shorten about all of that. That in tandem with removal of negative gearing for established property cost him the election, and
twice.
So we have to take the temperature of the industry, and not just listen to investors like me who are saying no, we shouldn't do it. I mean, clearly it will impact me if that comes into play, and I'm not very excited about it at all. But we need to look at the people that we're trying to really help, which at this stage, the housing crisis is on every politician's agenda, and they've got to have a really close look at what the unintended consequences will be if they disincentivise investors. Once we've got all of the taxes rolling in and we're building all of the buildings and we've got government-owned social housing for enough people, if that ever happens, I might add, but once we have that nailed, you can then start talking about how to disincentivise private investors. But right now, we need them.
That's the thing, isn't it, Dave? Like, there's no one there to take up the mantle from property investors. Like, if the government was like, we have 3 million dwellings about to enter the market, then it's like, okay, well, let's give investors the bird because we've actually got a solution.
Yeah.
Yeah. Unfortunately, I don't think the politicians think like that. Certainly not the ones making the decisions at the moment. I think there's a real risk that capital gains tax will increase, particularly for property investors. So I think it could have a material impact on prices and price growth, which obviously a lot of people wouldn't be unhappy about. I think
no one wants to think that their home will be worth less because there's been a sudden number of investor-led sales taking place that have devalued their own asset. Nobody wants that. The banks don't want it. We've got to think really carefully about this. What could it do? Anyone who's thinking of selling in the next 10 years, and we've got a large cohort that will be thinking about selling property when it comes time for them to retire and reinvest the money in other asset classes. I think anyone with a 10-year selling horizon who's told, hey, capital gains tax discounts will be removed by X date, we can absolutely expect a cohort to run towards a selling agent and list their property for sale. And what that will do is influence prices for the short term, perhaps, but there's a lot of people that won't like their property being devalued.
I was in the Sunday papers
definitely.
talking about that and shared that on LinkedIn, and I got an absolute toweling from a few commentators who sort of believe that when a property investor exits, a first home buyer takes their place.
You know, it's such a Pollyanna view, because it's not what happens. Not always. And we've got to think about where these first home buyers are moving from, because if they're moving out of home, are we solving the housing crisis?
Yeah. And I think you go back 70 years, around about a third of people rent and have done for a long, long time.
For decades. It's always been a third.
Yeah, they're new migrants, or they're only there because of a job, or they don't have the credit rating, or they're on a government benefit because they're not able to work full time. A million different reasons why people aren't ready.
They've got assets in other asset classes or whatever. There's so many different. I meet that many people that have their wealth in shares, and they're not comfortable being tied to property, even for a home, or they're itinerant, whatever. There's so many reasons why people not just get stuck in the rental trap, but choose to rent.
Yeah. All right. Well,
I think it's a real risk. That's what I'll say.
Good.
But I think it's a risk that the policy will be put in place as well.
Yeah.
And I do think it will mean there will be less people wanting to buy investment properties. And some people may sell depending on whether they grandfather or not, or there's some sort of timeline for when it applies to any existing assets. Yeah. But the jungle drums are beating pretty loudly on this one. And when you've got a government with such a majority, and then also in power in most of the other states, that's when you can make bigger decisions like this.
Well, stick with us. We'll keep you across it. And if it does look like being legislated, I think we'll maybe do a deep dive on it. I've seen some modelling to say that prices would contract by 1%. I think that's underestimating it a fair bit. And I think what's more interesting than the market on a decline, which of course speaks to state revenue through stamp duty and all those sorts of things, is the impact on rents. So that's a big one. But let's move on. Let's talk about listings. We've got some interesting listing data in for January, and I don't know, it kind of seems like maybe it's good news with a little bit more coming onto the market. Cate, you're more of an expert on the markets and when people come to market and the seasonality around January and December. What can we take from this?
Yeah, look, a little bit of a pinch of salt, to be honest. We're looking at 2 consecutive months that are, I'm not going to say anomaly months, but in the scheme of things, that's generally the shutdown period. So if we're comparing January listings to new December listings, well, you don't get very many vendors launching brand new listings in December in the capital cities. You tend to see all of that activity rolling through in November, and then December is when they all get snapped up, and then we go into a bit of a hiatus. So this is a tough one to go through. Distressed listings was probably the one that I would have had a closer look at. But what I will say is new listings, Perth, what's going on there? The monthly change is negative. So that explains why Perth is soaring. They've got a real stock shortage. And in the total listings, you can see that as well. Yearly change, they're down almost 22%. But for the month, it's 3.8 in the month that we should be seeing a burst of new listings. So I wonder what's going on there. And I also feel the same about Hobart. Even though we're talking smaller numbers, we've had 562 new listings in January, but 733 in December. What's going on with Hobart? Vendors aren't listing.
Well, I mean, it feels like Hobart's just about to start making some gains. So possibly the wrong time to sell, I think, is the reason there. But interesting point when you contrast like Perth to Brisbane with a monthly contraction in Perth, but nearly 20% monthly increase in Brisbane. That maybe says to me that the handbrake might be starting to come on in Brisbane, but we've got a little bit more to run in Perth. But it is hard to read from December, January, and these 2 months.
Yeah,
right?
show me the Feb, and I'll be a bit more opinionated. I think this one it is interesting, but what it shows is that the capital cities that have been performing strongly or have done a quick pivot, it's related to supply, maybe more so than demand. It's certainly related to supply, though. We've got a shortage.
Dave, buyers agents are reporting that it's bloody hard to get stock at the moment. And when you look at old listings and the yearly percentage change, every single capital city has seen a reduction in old listings. And Cate has talked a little bit about that. It's maybe those ugly duckling properties that don't sell in a balanced market that are just getting snapped up. What's your read?
Yeah, well, one of the numbers that Cate put out was the estimated number of homes advertised for sale is 19% below levels at the same time last year. I mean, that's 1 in 5. So there's, 4 not available. You've only got 4 properties for every 5 that were available 12 months ago. But even the 5-year average, that number should be going up because the number of houses grows every year, the population grows every year. It's even worse. It's 25% below the 5-year average. So, the average was at this time of year, there would have been 4 properties for sale. Well, now you're competing for 3 instead of 4
It's tough.
with more buyers because obviously the population's gone up. So, this is a core number as to why prices continue to rise.
Yeah, national for sale listings 19% below last year, and as you say, 25% below the 5-year average. So it's tight, but this January print maybe speaks to a change. But as you say, we need to wait for February, and there's a few other things we need to wait for while we're at it: consumer sentiment, lending indicators. Obviously, we talked about lending last time.
Look, one interesting number that I didn't share in the last episode. So for the quarter, September 2025 quarter, the number of loans for new purchases, investor numbers hit its highest level on record. So there was 57,624,000 loans for investors, which was the previous highest was 51,000 back in June 22, and this number has been recorded since 2019. So investors are really flying. So owner-occupiers was 83,000. Its highest number for owner-occupiers was 94,000 back in June 22 when the market was absolutely flying. So, that is part of what's feeding into some of the government concerns, some of the APRA concerns is just investor numbers are getting so high.
It's really interesting considering we mentioned this in the last market update when I was a bit surprised with the Westpac Consumer Sentiment Index showing that our appetite for housing was matching this time last year when we were staring at, a lot of chatter at the very least consecutive rate cuts. And even though we've just had a rate hike, I know anecdotally my investor inquiry has still been very strong. I think that the rate increase will dampen a few spirits and it will certainly dampen some budgets. But what it's doing is having investors circling into the lower price points, and that bottom quartile up to the medium quartile, certainly in Melbourne. But, across the board, the bottom quartile's been strong. And what is that doing to locals and to, owner-occupier, particularly first-time buyers? It's making it very competitive for them. So it's a very interesting market. It's so segmented.
Yeah, and it really is that lower quartile. And again, that happened in January. I've just got the numbers here quickly, but the low quartile across the country, values were up 1.3%. So that's obviously growing at, 14, 15% per annum. The upper quartile only rose at 0.3%. So 3.6% per annum. So everyone, every man and his dog, investors, first-time buyers, upgraders. They're all competing in that bottom quartile across the country, aren't they?
It's fascinating. I was chatting to a lot of agents. We send them out our client list and they ring back saying, "Oh, have you got anyone for blah, blah, blah?" And I get a lot of phone calls and text messages saying, "Have you got anyone at, the 4 million or 5 million mark?" The reality is I've had a lot less of them in the last couple of years than I've had in previous years. That top end of town, it's come right off. And you chat to any of the agents looking after, the high-end properties or the illustrious blue chip suburbs around your way, Dave. It's a tougher gig for them. And that is really interesting. And not everyone has a spare 5 mil, but if I was in the market for a $5 million house, I'd be arguing that it's probably not a bad time to consider that. It's the one segment of the market that's not performing.
Yeah, that segment, that higher end segment. And you could probably make a case that it's in most markets, it's probably from 2 million upwards, but certainly as you get into those high numbers, 4 or 5 plus, it's been flat for some time, hasn't it? And
anemic is your word.
Yeah, so you can get a good buy in there, and is that going to change at some point?
Keeps me up nights worrying about these people and Dave maybe having to cut back on caviar because the top end of town's suffering a little bit.
Yeah, boo-hoo.
Love our caviar, Mike.
I don't need to hear from you, Dave. I've already decided exactly what your life looks like. In fact, I don't actually want the truth because that'll destroy the illusions that I've built for myself. Speaking of, being a mover and a shaker at the top end of town, Dave, what has the market done in response to the RBA increase? I see the Australian dollar is holding above 70 US cents, and the market's had a little bit of a rally.
Yes. So, the Australian dollar has been very strong. And in terms of the 3-year yields, they're basically about 2 rate rises or, 50 basis points, give or take, above where the current RBA rate sits. So they're currently expecting the average rate over the next few years to be about 50 basis points higher or just under that. So, so that's what the markets are thinking at the moment. And I think they've pretty much priced in, I don't know if I've got that here, but another rate rise by about August or September? They've pretty much priced in another rate rise in the next 3 to 5 months. I think
even the RBA are talking about the back end of this year is the potential for the next one. It sort of says to me that they want some time just to observe rather than sort of hitting us with the hammer, a couple of months in a row.
Yeah.
Yeah, I think they'll wait for the first quarter's data before they do another move.
Agreed.
And we talked a little bit about unemployment not necessarily behaving the way the RBA has expected, and you referenced it a little bit earlier, Cate. What are we talking about in terms of unemployment?
Well, we've got a couple of sets of data here that we can look at. We've got seasonally adjusted, and then the key stats. So our unemployment rate decreased to 4.2 in key stats terminology, and in seasonally adjusted decreased to 4.1%. It's pretty tight. The participation rate increased, and full-time employment increased as well. So we've got a pretty tight labour market.
Yeah, it is a weird thing, as you referenced before, that we're kind of talking about, we need unemployment to rise because we need spare capacity, we need capacity to grow. But it is a bit of an odd thing when you're talking about human capital rather than human beings becoming unemployed. But I mean, it is the reality. If unemployment is too low, then we have wage price growth get out of hand, with domestic demand increases, and it leads to inflation. So it is a little bit of a balancing act as much as it is a human story.
Yeah,
very much.
Well, That's a fairly good synopsis of January. What have I missed? Does anyone want to put their hand up for any other insights for the month?
No, I think we nailed it. We've talked about
pretty well, Mike.
the two big topics. Well, we didn't touch on American politics whatsoever, and I'm not inviting us to do so. I think we've done pretty well.
Yeah, look, I think I could maybe just mention the inflation numbers, which is, I guess, the primary reason why rates have gone up once so far. So the trimmed mean inflation rose to 3.3%. Obviously, the RBA wants it between 2 and 3%, and ideally right in the middle point of 2.5%. So what were the most significant price rises at the group level was housing, 5.5%. So the cost to build new houses is still rising pretty rapidly. Recreation and culture, so we're spending a lot on that, which says, we have some excess cash flow, but also that people are feeling comfortable to charge extra also. So that jumped at 4.4%, and food and non-alcoholic beverages also jumped at 3.4%. So they were some of the key factors that fed into inflation over the last 12 months. Yeah.
We're a bit spendy, but we're also maybe a bit thrifty at the same time, which sounds like a counterpoint. But I wanted to ask you quickly, Dave, refinancing. So in Q3 2025, we actually hit a record of $65.8 billion being refinanced. And if you crunch the numbers, that's $500,000 refinanced every minute, which is maybe something that the politicians need to lean into as a tangible thing to talk about spending. But what are you observing in the mortgage game in terms of refinancing? Is there a reason? Are there deals out there, or are people just tightening the purse strings as much as they can?
Yeah, it's a good one. I actually did have that. Yeah, I had the highest number of refinances ever in the September quarter. You've got the total dollar value, and it was 164,000 odd people who refinanced. What do I put it down to? I think, I think people are wanting to tap into equity. I think they're wanting to give themselves buffers. I think they're wanting to save cash. I think, there are offers available. I think through COVID, people started refinancing at the highest rates ever, and now it's more in people's psyche to refinance even more often than historically we used to, and we still historically as a population refinance pretty often, but I think people are more willing to do so now. I think the cost of living challenge, the fact that inflation keeps biting us, I think that's all feeding into these high refinance numbers.
Yeah, interesting. Well, if you haven't looked at your mortgage, now is probably a good time to do that with the shifting sands and RBA. There's a lot that a strategic mortgage broker can help you out with there. But that
particularly one of our guys at Property Planning Australia, they're more than happy to help.
I figured my sales pitch was enough, Dave. But we'll put your address in the comments, but only underneath the link to go and get your tickets for this live event. If you haven't done that, please do that. We'd love to see you there. But in the meantime, that was the month of January. We've got heaps of content coming up in the lead up to that event. We've got lots of listener questions, and we're going to be featuring some listener questions live on the night as well. So very much looking forward to unpacking that with you guys.
Yeah, we should also mention that we want to do a bit of a special market update. So not exactly the format that we do each month with the data. We will be doing something a little bit special along those lines, though, and answering some questions from the floor as well, some of which we've already got. So really excited.
Be there or be square.
Look forward to it. And it is surprising how many listeners say, I didn't know what you guys did, didn't know what your business did.
Yeah.
I thought I just should mention it every now and then.
That's a good thing.
Awesome.
I look forward to seeing you guys next week.
See you next time.
See you next week.
See ya.
Bye.
Bye.